Hi everyone, it's Jab out with another video. Today I'm going to talk a little bit about Alibaba, but mostly about what's happening with Chinese stocks at the minute and growth stock in general today. Up ridiculously, this is the best day in the stock market since 2008. Growth stocks went absolutely berserk. Alibaba and other Chinese stocks in particular went berserk today. Alibaba was up 36%, still down 55% year to date. This is the first really good news for Alibaba all year. I was getting kind of used to the idea that every time there's a green day, Alibaba's going to be down. This really, as I'm going to be talking about, the first big potential catalyst to change the market outlook on the stock, which is absolutely excellent. So the huge news for Alibaba and for all Chinese stocks and investors in general actually is that the Chinese government policy, at least on the face of it, is moving in favour of investors and moving away from the crackdown on internet companies. This was straight from the horse's mouth of the Vice Premier of China's top financial policy committee. Or crucially, they will work to prevent a collapse of the property market in the wake of the China Evergrande crisis. This will help a lot of US-based companies, particularly the banks, who would have loans that they would default on, because there's a big knock-on effect that this could possibly have. But it seems like China's banking regulator has said they're going to increase investment in the stock market, support insurance companies to do this, and prevent the stock market, property market collapse. All this amounts for an excellent catalyst for Chinese stocks to grow in the short to medium term. Previously, only earlier today, I was seeing talk of Tencent and Alibaba having massive rounds of redundancies and sackings, getting rid of staff because this crackdown is hurting them so badly. Not to mention the investors who've seen the investments, they're now a third of what they were a year ago. Excellent news, and really what this is goes a little bit of the way to recouping some losses, but most importantly, I think it's an excellent catalyst for Chinese stocks to be seen as it removes the fear, essentially. It's a catalyst for slowly removing the fear of delisting the market, because it seems like the Chinese government are now against delisting companies for no real reason and want to work with US regulators. So this should reduce the fear dramatically, in my opinion. And the result was that Chinese stocks are absolutely back. These are four companies that I picked off the top of my head for the main ones that I look at. Pinduoduo was one of the worst performing stocks on the Nasdaq last year. I think only maybe Peloton on the Nasdaq 100 did worse. No surprise, this is the biggest beneficiary. Best day in its history, up 56%. Best day in Alibaba's history since going public, up nearly 37%. JD.com nearly 40%. Neo, which I made a video on only a couple of days ago about how cheap I thought it was looking, up 25%. I look like a genius now for a couple of days. All nowhere near the highs, of course, but this is absolutely a start. This is a start in changing the narrative on these companies, because for a long time I thought the delisting fears were largely overblown, and it seems like the Chinese government are confirming that they don't want this to happen. Of course, as I mentioned with Alibaba, still 55% down year to date, even after this increase. That leaves it with a forward PE ratio of 11, which is still below the S&P 500 average for a company that's just grew its revenue 30%. So still, investors are far taken for granted, or the market is far taken for granted, the growth potential of this stock. Looking at the price of free cash flow of just 10.5, actually reasonable for the industry because all the Chinese stocks are so beaten up. But versus Alibaba's history, this is some of the cheapest metrics you will find in it since it's been a public company. PEG ratio 1.27 is not absolutely bargain basement cheap, but it's pretty cheap by my ratings, close to 1. Every metric I'm looking at here makes this very, very cheap for Alibaba's history, if not the cheapest it's ever been. Of course, a couple of days ago it would have been even cheaper, but that is meaningless in the grand scheme of things, in my opinion. I think now looking at these numbers is a reasonable time to invest in Alibaba, but first of all, I'll look at the balance sheet. Just briefly looking at the balance sheet to confirm there's no serious red flags here. Cash debt ratio of 3.54. Strong position for the industry, not perfect for Alibaba's history because the debt is slowly creeping up as they make some investments in the cloud portion of the business. 74 billion in cash on the balance sheet. Debt to EBITDA of 1.39, so the debt is relatively well covered what little debt there is. Interest coverage of 4.35 is not amazing, but is decent. Company has an Altman score of 2.65, which in this case is slightly in the grey category, but I don't believe there's any real problems there. Debt is highly serviceable and well covered by cash, so I'm not concerned in the slightest. Looking at the profitability metrics, operating margin of 8.47% and net margin of 7.9% are not amazing by any means, and are actually quite weak for Alibaba's history right now because of obviously a lot of supply chain problems and a lot of things squeezing on those profit margins, as is typical for 2021 and early 2022. But for the e-commerce industry, these are pretty good, and these are only going to increase as the cloud portion of the business becomes larger. Return on equity and return on assets are not amazing, but again, this is a very asset-heavy business, so I'm not so concerned about that. Looking at the analyst estimates for the next few years, again, of course, take these with a pinch of salt because these are estimates, of course, predicting a 17.13 revenue growth rate average over the 3 years. Revenue is expected to come in at 135 billion in March 2022. In March 2023, expected to be 157 billion. And 2024, 177 billion. Earnings per share without NRI is expected to increase from 7.64 to 11.38. Really nice growth over that period. Very impressive. And I'm predicting that Alibaba can do this no problem really, as long as it keeps up how it's going at the minute. Next stages, I've done a DCF, going very conservative in this with both examples on the screen. On the left, 5% free cash flow growth, on the right, 10% free cash flow growth. Over the past 10 years, Alibaba has increased its free cash flow on average 51.4%, which is obviously absolutely incredible. They're not going to do that going forward. The last 5 years, 28.3%, which again, I think is achievable for a few years, but over 10 years, I don't really think it can do that. And in the last year, free cash flow was down 12% or so, but again, a lot of problems, increased competition, supply chain challenges. So this is to be expected. The margins have been hit a bit, so I'm not so concerned about the near term. I think 5 or 10% is both absolutely achievable. 5 certainly, very conservative in my opinion. 10 is definitely achievable. Somewhere in the middle is probably where it's likely going to be. Revenue again grew 37% last year. They're putting a lot of investments into the cloud, into infrastructure, so not so concerned. With a 5% growth rate and a 9% discount rate for the long-term returns of the stock market, that gave a fair value of $134.61 compared to today's stock price of just shy of $105. That's a decent, around 30% upside. Pretty decent if you ask me. Going with the more optimistic approach of 10% growth rate, that gives a fair value of $189 compared to $104 today. So what's that, 80% growth? Absolutely fantastic. Huge upside potential here if you believe in even the slightest amount of free cash flow growth going forward. Essentially, if you believe that Alibaba is going to be a significantly bigger company over the next 10, 20 years, then this is an absolute bargain right now based on its fair value. Who am I to know if this is going to be the end of the pain for Alibaba? There's, of course, a load of macroeconomic things going on at the minute. The war in Ukraine. There's local lockdowns in Shenzhen, in particular in China. So who knows what's going to happen? All I know is this catalyst in that the Chinese government seems to be easing the approach towards internet companies, and this massive jump in the stock price today shows that the market is kind of cooling its fears on Alibaba's delisting potential. I think this is really good going forward. Most of Alibaba's losses have been due to fear of regulation and delisting. The Chinese government are making an open commitment towards this. Hopefully they will interact with US regulators and the SEC in the future to get their finances sorted out, and so companies are reporting correct numbers and numbers that can be audited by US companies. Then I could see Chinese growth stocks perhaps not returning to their absolute highs, but definitely being strong investments and good beta potential from here going forward. Of course, some of the highs, for example, Pinduoduo, that the high was something like $198. It's at 42 today. Can't see it getting back to that for a while. Maybe, who knows how long, 10, 20 years. But what I know for the time being is I think Alibaba is a reasonable investment and is trading at a significant discount to its intrinsic value calculations, even with conservative free cash flow growth. And now the delisting fears seem to be easing. This seems like a screaming buy in my opinion. But of course, I'm not a financial advisor. You should not take my financial advice. This is financial advice, or take it literally. What you should do is do your own research and due diligence. Please, if you're enjoying the video, like and subscribe, and I'll see you again next time.